Hey everybody, this is David Scarica. So as promised, here's our stock chart of the day for um sorry, my cat is biting my feet. Uh for uh today, I think it's August the 1st. So, the Fed met yesterday. So we're going to kind of concentrate on the TLT and short-term interest rates for this stock chart of the day. So what's interesting is, I've talked about the debt hitting the market, et cetera, et cetera. But it does look like in the short term, because of the Fed's now pivot. Now it really is a pivot. I've been saying for a long time they wouldn't pivot, but even I had been calling for rate cuts this year. So we went from the market being ultra dovish at the beginning of the year to kind of more hawkish in that, like, at one point it almost looked like they might even not cut rates this year. Now we got, like, basically, we're going to see 3 rate cuts basically priced in. And if they think inflation can stay around the 2 to 3% mark, I looked up the Fed funds futures going a year out. They're looking at 150 175 basis points worth of cuts, about going out to about this time next year. So this kind of makes sense, because if inflation is reported at 2.5 to 3%, bringing that down to 4% would make sense. So, remember, we've had a huge bear market in bonds, one of the biggest ever, since the 2020 top. You can see that the TLT peaked at 155, crashed all the way to 80. So bonds fell almost 50% in price, long-term bonds. And now you can see that we've rebounded a bit. And you can see a 1, 2, 3, 4 straight. Well, actually, this year was up here, but like, we've gone down for 4 years, and 1, 2, 3 straight down calendar years. I think that's the first time bonds have ever done that. Even in the 70s, they didn't do that when rates went to double digits, because they would have rallies or an up year or whatever. So you can see that. So it does kind of look like you moved here. This is here. And, like, if we can break, first of all, about this, where we are 95, then we can go back to here, and then we can go back to about 105. So, and if we draw, like, let's draw, me, I like to draw my trend lines. So let's draw a downtrend line. So you can see here, we're way ways away for that. So maybe we rally back to the downtrend line. And if we look at that, you're talking about 115 or so. Now that downtrend line might continue to actually 120 could continue to go out. So maybe by the time it gets there, it'll be 110 or something like that. So that kind of makes sense. And that also makes sense in my long-term view of where I think these rates are headed. Because when we look at, I talked about, the one step up, the one step down. So let's go look at the long term. Let's go look at the long term TNX, which is the 10-year bond yield. And this is the way these interest rate cycles go. I talked about that in that video I put out yesterday. So this goes back to the 60s. So we're going to go back. We'll start this in 1962, which was definitely a better time. I'm going to take out for this. I think I can take off the log scale, put it linear. Yeah, because that shows this a lot better. So you can see, you can see the secular bear market in bonds, bull market in interest rates in the 60s and 70s. And again, you had drops here in 1966. You had drops here, and that may not look like much in 67 actually, but that fueled a big bull market from 66 to 68, and then the drop here from 70 to 72. Then the drop here, and then the final move higher. And even you can see here in 80, there was a quick drop before the final move higher. So then you've had, again, on this way down, you've had these, spikes in 85, 87. That's what helped cause the 87 crash, 94, 99, 2000, et cetera, et cetera. So I don't need to talk about every single one. But as I noted with the short-term rates in that video, you can see the long-term rates for the first time, really, all these highs were basically, this one was kind of a little higher than the 2014 high, but not really significant so. But this is the first time we have significantly see a new high. So we went from essentially 0 to 5%, and now we're around 4% on the 10-year bond, or 10-year bond yield. So yeah, could we go to like 3%? Yeah, sure, right? We can go to 3%, 3.5%, or even 2.5%, because that would essentially, like, we went up 450 basis points. Well, do the math. If you went down 50%, that would actually put us at 2.75%, probably before the next move higher. So that's kind of where I'm viewing here. So we're kind of in this probably cyclical bull market within the secular bear market for bonds right now. So then, like, let's go see what the Fed's what is going to do. And I think Trump is going to put, if he wins, a lot more pressure on the Fed to be dovish. he did that, in 2018 when they raised rates a few times. When the stock market fell 20%, he essentially put pressure on them. Then they began cutting in 2019. Before the cut rates to zero over COVID. So you can see this is the next Fed meeting. There's an 84% chance that they cut a quarter. Actually, there's a 15% chance they cut a half a point. And then in November, we can see, we're actually at nearly a 75% chance of at least another quarter. And this would be like, again, or could be as much as 75 total between those two meetings. And then if we go, let's just go out a year, so you don't need to look at every single one of these. So a year would be July 30th of next year. And you can see there's roughly a 60% chance that the Fed funds rate is 350 to 375. And, almost, an 85% chance that it's 375 to or 400. So 375 to 400 is 150 basis points, and 350 to 75 is 175 basis points. So essentially, we're pricing in 150 to 175 basis points between this year, right now to next year. Now, who knows what can happen? Like we've talked about, I've talked about the potential of a big market decline. Obviously, the market's going to see a bit of a relief rally here. You're seeing the NASDAQ up good today. Dow's kind of lagging a bit here, but Dow didn't sell off as much. And we're seeing the NASDAQ bounce. And so the question is, if this is the start of some kind of big, sharp decline in the markets, we'll probably see them cut even quicker. But I think this is like the last hurrah for cuts, in that, if they print money at these debt levels and coming from already an inflated, CPI, the CPI is still hanging around 3 to 3.5%, you're going to see massive inflation the next move higher. So, I think that's part of the reason gold and silver are holding up, etc. So anyhow, we'll look at this here going forward, and so we'll look at everything here. Sorry. Going forward, I'm pretty, pretty positive now, and I think everyone is, that they will cut rates, etc. So, so that's today's stock chart of the day. It looks like we are seeing this kind of rally in bonds, breaking short-term resistance. Probably in the short to intermediate term, we'll continue to see rates lower, and but that doesn't have to last forever. That could just last, I don't know, into like, what happens if the long bond, for example, starts selling the news? Say it rallies for another few months here, and then when they start cutting, it continues to go lower. Because the issue too with the next recession as well is they're already running a $2 trillion deficit. So what happens if that expands to 3 or 4 trillion during the next recession, when outlays go up and revenues come down, as they often do during recessions? So that kind of supply will be hitting the market. And the question is, will be the demand? When everyone was fearful over COVID, there was huge demand. And part of the reason was people were speculating in bonds too. Because remember, again, when bond yields go down, the prices go up. So I don't really have any skin in the game in the bond market. I've talked about the LQD short trade in the past. I'm not in that trade right now at the moment. I'm kind of waiting for this interest rate rally or bond market rally to play out. So there you go, stock chart of the day. Looks like bonds are kind of breaking out of short-term base. Looks like the Fed will start cutting, and over the next year could cut between 150 and 175 basis points. Thanks very much, everybody, and have a good one.